there is news this morning that we added 261,000 jobs in October. And obviously, given that there's an election in a few days, then, the administration is eager to point to this. But if you dig a little deeper in the report, I just posted the link there, you see in the raw numbers that there's actually 328,000 fewer employed Americans. And the number of unemployed Americans actually increased 306,000. So, and the labor force participation rate declined for the third consecutive month to 62.2%. So, I don't really understand how all these numbers add up, but the point is the data is very mixed, and there's definitely
mixed.
Negativity in there. And this feels to me like the last gasp of the bull market where there's this residual job creation. But you look at just what's happened in the last week where it's Stripe cutting. I mean, Stripe's probably the single highest quality. I think it's probably the most valuable private company in Silicon Valley.
Yeah, SpaceX is. Oh.
Well, SpaceX, okay. But pure software company, they had a 14% cut. You're starting to see now the RIFs really start to pile up. So I think we're at the beginning now of a long cycle of the unemployment rate going up. I mean, it just feels like the economy is slowing so fast. The markets are, they've been puking now for 6 months. It just feels like this is the beginning of a really serious recession.
Yet we had GDP growth. Yet we had job openings.
Well, no, remember
increase.
we had 2 quarters. We had 2 quarters of net negative GDP growth. This is when we had the debate about what a recession is. It was true that if you looked at growth in nominal terms, it appeared to be strong, and then it was net negative once you subtracted the inflation rate. We said several months ago, or my prediction was a double dip recession where you had this shallow technical recession, then it bounced back in Q3. But now I think we're headed into the second part of it, which is the real recession, a recession characterized by joblessness. And you're starting to see economists say we're going to go from 3-point-something% unemployment rate to say 5 or 6% unemployment next year. So I think we're just beginning to see the job cuts start to add up.
I think this is what Powell meant, which is, he'll take it as far as it takes, and then he can fix it on the back end by reintroducing, quantitative easing and reintroducing lower interest rates to stimulate demand. But there's
what are the odds he gets this right? It seems to me that the Fed has a habit of reacting too slowly. They were too slow to react to inflation. My guess is that they'll be too slow to react to the recession. So we'll end up with a period of rates being higher than they should too long, and then they will correct. They'll drop rates, but that could be 2 years from now. And meanwhile, we could be in a pretty deep recession.
I think you're probably right.
Here are the 2 charts for you to look at: the GDP by quarter, and then after that, the labor participation rate. So there's your GDP, Q1, Q2 being negative, Q3 bouncing back. We'll see what happens in Q4. And then here's your Fed force participation rate for labor, as we discussed.
The thing with the labor participation rate that we're still not sort of truly factoring in is we had 1 million Americans die because of COVID. And, starting in that Trump presidency, we lost 7 or 8 million immigrants. So those 8 million people have a huge effect on this number.
Yeah.
Right. And it's not properly really factored in because if you see that at the start of the Trump presidency, it just fell off a cliff, basically.
And you also have people who retired early. That was a big trend. And this all peaked in 2000, labor participation hitting that 67, 68%, I think is the peak. And just slowly going down as boomers retire early because they made so much on their 401ks and homes. And then you're right, Chamath, we've really cut immigration the last, 5-6 years.
I think there's an element in here that's missing on how much people individually are finding other ways to earn income. That doesn't qualify and show up in the labor force numbers. People have set up Etsy stores. Shopify stores have tripled since COVID. People are making more money on YouTube, on Instagram, on TikTok than ever before. There's a whole new class of work that revolves around the individual creating their own business, creating their own income stream that's simply taken off and has taken off. It was kind of a trend pre-COVID, but it really took off during COVID. And there's an element of this that's really more about the transition of how people work and how they earn that isn't reflected in these numbers. I don't think that the idea that everyone should go be an employee at a company is necessarily the right way to think about labor going forward. The amount of money that individuals are earning is probably the better way to frame this up going forward, and as really thinking about the earning power and the economic health of this country.
This is something important you're bringing up here. Gig workers are about 9% of the workforce, and Uber and Dara had they grew over 70% this year. But I think the big number that I watched for was drivers are making $36 an hour in the United States working for Uber. So you're exactly right. People are finding other options, whether it's DoorDash, Uber.
And that doesn't
Etsy.
Qualify in labor force, right? Because they're independent contractors.
Independent contractors are counted, yeah.
They are counted.
That's based on my preliminary research. If somebody wants to fact check us, that'd be great. But my understanding is independent contractors, which is what gig workers are classified under, are counted in labor participation. I don't know how they're counted. So we'll look that up and figure that out.
There was a story in BBC that the Bank of England has now warned that the UK is facing its longest recession since records began. Some of this is getting to be fear porn.
Yeah.
But look, here's what I think is scary about going into a recession is, number one, you don't really know how long it's going to take to get out. We know the average recession lasts about 18 months, but the truth is once it starts, you just don't know. And the second thing is you don't really know who's been stress tested. People claim that they can weather the storm, but the truth is that there's no way to truly simulate a stress test. They claim they can, but the only way is to really subject an institution to that pressure and that stress. And then you see if they come out the other side. So that's the issue is you just going into this, there's a lot of unknown unknowns. And this is why I would just urge founders to be cautious, is because if the recession ends up being shallower and shorter than people expect, great. You'll be surprised to the upside. But if the recession ends up being deeper and longer than expected, you don't want to go out of business. You want to be protected against that. So again, we've been saying this since February and May, but again, I just reiterate, I think it really makes sense for founders to be conservative, prioritize your survival above all else. This recession probably will last about 2 years. You want to make sure you survive it. And to Chamath's point, if you survive it with lower growth, that's fine. You can keep growing on the other end of this thing. But if you go out of business because you grew too fast, then you're not going to get the chance to fix that problem when the recession is over.
I just don't see anybody rewarding hypergrowth that is burning a ton of cash, where you have to be back in market every year, because it's just very hard to feel comfortable that the conditions on the field aren't going to be drastically different a year from now, right? It's not like we know that it's going to be better or worse. And I think that uncertainty is actually really bad for companies. So to your point, it's just like a lot of folks have tried to shy away, David, from actually revisiting their valuations. They've done these complicated converts, and they've tried to basically, I think it's sort of like managing their ego or the board's ego. And I think like the next shoe to drop has to be these founders and these boards just saying, okay, let's just take the hard medicine. What's the real, market clearing price and valuation? Let's get a third party to price it, and let's get new fresh equity and then move forward. Because if you don't do that and you wait until everybody's trying to do it, then it's going to be a really tough scenario. So better, to your point, this is why like Stripe, it's so smart. Better to cut now. Again, it's always hard to let people go, but it's better to do that now than 18 months from now, because you just have no idea how much more expensive or hard it's going to be then. And who's going to even be in the business of lending money or investing money in 18 months? And that sounds pretty crazy, but it's like I think that's the moment that we're in.
To your point, Friedberg, I did a little research here, and according to the Fed of St. Louis, if you counted casual workers, informal workers, doing over 20 hours a week of informal work, aka gig work, you would increase labor participation between 0.5 point and 1 point. If you counted all of them, maybe even slightly more than 2 percentage points higher. So probably about 1 point seems like a realistic way to look at labor participation. And of the 8 points, or maybe now the 6 or 7 points to 10%, it would then account for 10 to 20% of the 10% drop in labor participation.
It's just alarming statistics, because if most people have most of their personal net worth tied up in their home asset and their home values are declining or going to decline, and we're seeing this dramatic spike in consumer credit in the US, it paints a really ugly picture for the next 2 years.
Wow, guys, I'm just looking at the markets today. GitLab's down 15%, Snowflake's down 13%, Monday's down 14%. Atlassian's down 30%.
In one day.
Wow.
Yelp is down 17%.
These are growth
Opendoor is down 16%. So it's just a horrible, oh my gosh, the cloud computing index, WCLD, has hit a new low for the year. It's down to $23. I think the previous low was 25. It's down almost 8% today. And this is on a day in which the NASDAQ is down less than 1%. So the point is that
people are rotating out of growth stocks.
Yeah, it's just brutal. And so listen, if you're a startup founder, you got to realize these are like some of the highest quality public
Twilio's
software companies.
Down 40% today.
Twilio is down 37% in a day.
Today.
Whoa.
But guys, this is just math, you know? It's not a judgment on any of these companies. It's just pure math. This is why I think you have to be utterly unemotional in this moment. And if you're a CEO running a company, particularly a SaaS business, you have to really figure out how to right-size your cost basis and make this money last.
Profitable industrial companies are up.
Bill Gurley had a tweet about this a few months ago about how the biggest mistake people make in riffs is they just do like a tepid riff, like a 10%-ish riff, and they have to come back and they do it again and they do it again.
This is what I think the Elon action this week really sets a standard. He shows the entirety of Silicon Valley that you can cut deep and you can turn a profit and you can do it fast. And it could set a new standard for how folks are managing this. Jack Welch used to, in his management principles, recommend dropping the bottom 10% of people every year. And so, you know, the 10, 13% cuts don't really pass muster as a public market investor kind of looks at the management across these different companies to turn a profit. They're going to say the folks that are making the deepest cuts the fastest are the ones that are going to get valued. It's unfortunate, and it's a difficult circumstance for everyone in Silicon Valley to deal with, from the employees to the investors to the public and private shareholders. It's really brutal.
One quick question for you guys.
It's really just this kind of market motivation that's underway right now.
Here's the chart. And then my question for you is, when do Google and Facebook stop this? I mean, if you look at the number of employees being added, it is truly extraordinary. Here's the chart. And this includes the latest quarter. So they are not turning off hiring yet. What do you think,
Chamath? Hold on. Didn't they announce a hiring freeze?
They announced that they were, at Google, they announced that they were going to hold people accountable to better performance and they were going to go do more with less. And then they added more people. Facebook said they would do a hiring freeze.
Today.
Yeah.
No, Facebook said it would do a hiring freeze.
And they added jobs.
Apple, well, whatever.
They added jobs last quarter, yeah.
Well, you're right. They just announced a hiring freeze. You look at Apple. Apple just announced in non-R&D functions a hiring freeze. This is Apple, like the most valuable, most profitable company in the world. So if Apple basically is putting the brakes on non-engineering hiring, that tells you something about how fast the economy is slowing down. I think that was a huge signal.
Yeah.
The point Friedberg makes is so correct, which is if you're doing a riff, obviously there's a reason why, but I think we're seeing too many riffs where the details of the riff and the magnitude of the riff don't match up with what the objective of the riff is. The objective of the riff for a lot of these companies should be to get them cash flow positive, or at least to put them on a runway or a trajectory where they can get cash flow positive with their existing cash on the balance sheet, right? They won't need to raise money again. And we're seeing a lot of companies where they don't achieve that and they have to come back again and again and hit it again. And that creates more turmoil for the company, and it's more unfair for the employees.
By the way, Sachs, to that point, I'll just say how deep these companies are cutting and how quickly management is expressing to their shareholders how they're going to turn a profit becomes a signal for those shareholders on whether or not they want to stay in that stock. And the companies that are doing it fast and are doing it deep, the investors and the shareholders say, you do actually have a path that makes sense here. I'm going to stay in the stock.
Cash today versus cash in the future.
Chamath, let me ask you a question in terms of strategy for one of these companies, let's say the Facebook Corporation or perhaps even Google or Apple even. If they were to cut their expenses, which might take obviously a riff, and then because their stock prices are so depressed right now, maybe even a mid-cap one like a Twilio or an Uber or an Airbnb, if they were to cut costs and then start buying back their shares, which some companies have been doing, what would that do in terms of the market's appreciation of those stocks or management teams?
I think it's hard to tell. I think that if you have not lost investor trust, I think it would be really well rewarded. If you have become unreliable and undisciplined, even those cuts, I think, would be met with some amount of excitement, but probably not broad-based support. So, it just goes to narrative, meaning if Google did it, I think that people really trust Sundar and Ruth, and I think the stock would go bonkers. They would probably move very quickly into the echelon of Apple, and Apple is sort of a first among equals. Like they're just in a different class unto themselves. Facebook, I think, is a little bit harder because I think folks have gotten burned, and they would have to make some really, really deep cuts. But then, where do you do it? You can't capitulate on this meta strategy, but then the other part is where you make all the money. And so you have this huge morale issue that you have to manage. So it's just a really hard game to play.
Just one more thought on the Rift stuff. I think one thought experiment for founders is to think about what was your plan at the end of 2019? Why do I say that? Because 2020 and 2021 were two of the most distorted years ever in the history of financial markets and the economy, because we had COVID and then we had the reaction to COVID, right? And so you saw there was this, Zoom's market cap hit 100 billion. All the e-commerce companies were doing extremely well. You had all this money printing. You had zero interest rates and so on. You had SaaS companies hitting all-time highs at the end of 2021. So we lived through this incredibly distorted time. So as a thought experiment, go look at what your plan for 2020 was supposed to be when you created it at the end of 2019, because that was the last time that you were thinking without any distortions, right, that were then created. And I think if you were to go back and look at your 2020 plan, again, created at the end of 2019, you'd probably see that you could get by with half the headcount you have now, because probably you doubled your headcount during the last 2 years during these heady times. And yet I think founders start thinking, I can't go back to operating, I can't operate at half the level of headcount. But you were operating with half the level of headcount by definition at some earlier point.
I also think sometimes what founders say is, what will people think if I cut 50%? Meaning all of a sudden the perceived success of my business would be different. And I think that this is where you have to realize, no, there's a lot of ego tied up in these things, which slows people down from doing the thing that they need to do.
Yeah,
it's tough
hard
spot
to do. I mean, look at Airbnb as an example. I mean, they did this ginormous riff during COVID because they had no choice. I mean, their revenue went essentially to zero, and now the business is incredibly strong. It's throwing off massive amounts of free cash flow, and the stock market seems to really love what Airbnb's done. And a similar story over at Uber in terms of having done significant riffs and probably could do significant ones.
Yeah, but JK, let's just be clear. Airbnb is still down almost 75% off its high.
Right.
So when you say the stock market love it, so they're up today 3%, so meaning they're not down 30% in one day, but have gone down with the rest of the market.
They have gone down with the rest of the market, but it feels like the business, I'm talking about the business fundamentals, when you're throwing off almost $1 billion of free cash flow. They've done a good job. Yeah, now you're going to people are going to perceive that business maybe as of this cohort, the flight to safety, right? Or same thing with Uber throwing off free cash flow now. I think a lot of these names are going to, I don't own Airbnb right now, but I do own Uber. I think the people throwing off the free cash flow are going to look pretty attractive and be able to buy their stock back maybe.